broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, thank you so much for joining the ACCA Study School Prepare to Pass, which is being conducted online and delivered across 14 countries from 2nd till 25th of November. Today I have with me Keith Rye from Becker Professional Education, who will take you through the key topics in P7, Advanced Audit and Assurance. Those of you who are attending the session at Approved Learning Partners, please write your questions on a piece of paper and hand it over to the moderator at your center, who is going to put up your questions to the tutor from time to time. However, those who are attending the session from home, please write your questions in the question panel on the right-hand side of the screen. The master moderator is going to pick your questions up and ask those from the tutor. The next person speaking is Keith Rye. Thank you, Keith, for joining us, and hope you all enjoy the session and good luck for your exams.
Right. Good morning, everybody. Thank you for attending and thank you for the introduction. As said, my name is Keith Rye. I'm a full-time senior tutor and author with Becker Professional Education. Becker is an ACCA provided content provider, and we provide a suite of materials all the way through from the study systems right the way through to what we recall as revision essentials, and you'll see extracts of that later. But we also do the mock exams, the mock exam marking, support, and everything you need, including this, to ensure that you have the best chance of passing. Right. This is, as you can see, related to P7. I always think of P7 as potentially being dangerous to your wealth and health, as it is the last professional exam to take, and for some of you, the very last paper. You may be doing this on your own as your last paper, but it's a fairly tough exam to pass, as that certainly as the students find it. So my aim today is to give you some ideas and tips in terms of how you need, or what you need to do in order to ensure that you are actually one of the 30 to 35% that pass. Right, let's just bring up, I think, first of all, it's a very good idea that as you are doing P7, that you actually love auditing. P7 is designed for auditors in practice, but I also appreciate that in a lot of jurisdictions you may be doing full-time, or you may not be able to get so much in terms of your P7 practice until you've actually qualified. That makes it a little bit more difficult, but it certainly doesn't make it impossible, as we shall see as we go through. Right, we've had the introduction and want to look at the house rules and how I'm going to approach the revision session. Okay, so we've had the intro. House rules, as we call them. Okay, we'll be taking a 15-20 minute break in about 2 hours time, halfway through this 4 hours. As we are going through, if you do have any questions, then those of you who are individual in terms of your questions, you can put those up onto the chat room. I will be looking at that, and occasionally the moderator might come in if I miss something. Those of you who are in groups and will have a moderator at your venue, then please put any questions that you have to the moderator. Then they will pass them through to the ACCA moderator, and those questions will come up onto the screen. As I said, I'm happy to take questions as we go through, but there will be hopefully some time left at the end of the 4 hour session in terms of being able to do some final questions for you on anything that you have. Always bear in mind, and we'll look at this at the end of the session, that there is going to be a mock review session. Okay, later on in about 2 weeks' time, you should have the dates for that already, and therefore there will be much more when we do that mock review session in terms of looking at exam techniques. So there'll be a further opportunity for you to ask more questions in relation to P7. The approach to this session. This is interesting in the sense of we're dealing here with a revision session and we've got 4 hours, but as you will see in a few minutes' time, P7 is huge in terms of what we can do. So there can only be a look at what I would refer to as the key of the core technique. The approach is basically going to be looking at a number of questions, and I will put those questions up on the video screen for you and give you a reference to them. If you have questions, a question bank, a study question bank, revision question bank, say perhaps the Becker system, or you're using one of the other providers, then you'll need to go by name. If you don't have a question bank, then I sincerely hope that you have already downloaded all of the past exam questions. Because if anybody asks me what is the absolute core of passing this exam, apart from, of course, reading through all of the study system, it is absolutely essential that you have practiced every single past exam question that you can get your hands on. We'll come back to that towards the end of this this session today. So that's going to be the approach to the session. I should apologize to you that perhaps my voice will crack up a little bit and I may do a little bit of coughing, but if I feel that coming on, I will mute my mic to stop that happening. But I had a very bad bout of some food poisoning or something yesterday, which was interesting as I was doing the F8. Happy news is I feel a lot better this morning, but I might start cracking up a little as we go through. It's strange because my voice is a little bit deeper. So please forgive me if after a couple of hours or maybe even 30 minutes of talking to you, my voice starts to go a little bit strange, but we will get there and you will get there. Okay, you'll see now on the screen I'm using OneNote, so I'll be diving into this at various stages as we are going through. So let me just move on using the PowerPoints. Everybody, obviously you have passed F8, but don't be lured into a false sense of security that P7 is just F8 plus. It's not. With the F papers, very often in terms of passing, then it's learning and just repeating the learning and applying. But as you progress up into even F8, there's a significant application and understanding. We'll look at this more when we do the mock exam review, and you'll realize this when you work through the past exam papers. But at P7, all of the professional papers, and hopefully you have passed, as I say, the professional papers, so you've got a very good idea of what's involved, but you have got to demonstrate that you are capable and you want to pass. It's no good just repeating things without expanding, explaining, extrapolating, analyzing points on higher level skills. So, exactly what are the key differences that you must realize and appreciate between P7 and F8, apart from the fact, of course, that you are at a much higher level standard? Well, in terms of the content, the first element is going to be looking at just dealing with planning and risk. All right, at F8, you know what planning is, you know the reason for planning, but risk. F8 risk, you were dealing with audit risk and only audit risk. Here, you're dealing with business risk, financial statement risk, which is also now referred mainly as the risk of material misstatement. And I've got assurance risk here. Assurance audit is a assurance approach. Audit is assurance. So assurance risk can also mean the risk of, for example, taking on a due diligence or carrying out any form of assurance apart from audit. You're going to get a lot more on high-level strategy in terms of determining what the strategy is. At P7, you guys are the partners, you're the managers. You are going to have to potentially write and develop an overall audit strategy or overall assurance strategy. For example, what are you going to do on a due diligence? We'll be having a look at a good due diligence question later. Materiality. Well, you think materiality is materiality, but with P7, you're going to get much more in relation to having to deal with performance materiality, and you're going to have to be thinking outside of the box. And this is an expression I use quite a lot. So if we have a box, F8 is inside the box. You can touch the edges. You have a comfort zone. P7, you're outside of the box. You'll be given pointers, clues, but from there, you have to move forward. We'll be having a look at some of that idea later. And again, I will say this time and time and time again, you must practice all of the past exam questions. You've got to understand what the examiner means and thinks. Understand how the examiner thinks. So with materiality, for example, at P7, you're likely to get much more on qualitative materiality rather than quantitative. Quantitative is calculation, 1–2% of turnover, 5–10% of looking at profit, net profit. That's easy, you can do that. But how do you deal with looking at qualitative? That's coming down to professional judgment, and that's coming down to having to handle with professional skepticism. Two very high-level P7 topics. Think about the accumulative immaterial errors on a quantitative basis. That's easy. You've got benchmarks to work to, but you haven't got a benchmark for qualitative materiality, where you are dealing with disclosures, where you are dealing with risk comments, forget F1, IAS 1, or where you're dealing with having to look at, for example, fair values and discussing fair values within the disclosure notes. So how do you know what is and what is not material, and where you hit the cumulative aspects? Logistics, getting the right people in the right place at the right time, briefing, supervising, reviewing, for example. Controls, all right, comes up occasionally, but analytical procedures. With analytical procedures, you're going to get much more dealing with substantive analytical review than you would at F8. Sampling comes up occasionally, documentation occasionally, but I will look at specific financial statement areas later. Remember, this is P7, so you are dealing with P2. You need to understand the recognition criteria, the measurement criteria, the de-recognition criteria, and the disclosures, all relating to IFRS from P2. If you just excuse me 1 second, I'm going to take the mic off. Okay, I'm back. That's just refreshing my rather dry throat. Okay, ethics and professional issues. Sorry, back to planning and risk. Are you going to get the question on planning and risk? Yes, you are. That's likely to be question 1. We'll have a. But ethics and professional issues, are you going to get the question? Yes, you are. Very high level P7 stuff. Fundamental principles, the safeguards, the confidentiality you all know from F8. But when we look at a question later on in this session, then you have to think what you would have thought at F8. Conflicts of interest, you may have covered at F8. Advertising, you would not have done so. Publicity, you would not have done so. There are a couple of excellent questions that have come up, and you will find them within your revision question banks. One of them was a repeat of an earlier question, just about. In terms of, here's an advert, tell me what's wrong with the adverts. Well, what are the breaches in terms of the publicity requirements? So working through all of the past exam questions, and you would have done that, would have made that question relatively easy. The expectations gap, that's a highly topical area, current issue, to such a degree that some of you may be aware that ISA 700, 705, 706 have been revised, and a new ISA 701 have been issued. I'm pausing here because I'm just waiting for some of you to be panicking and looking around. Okay, this is not for your exam, this is coming in from September 16 onwards. But that's all about the changes in the structures and the requirements of the auditor's report. Much more information is now being given within the auditor's report in order to try and reduce the expectations gap. This has been asked because it has been a discussion document, and the detail of this on going concern and the going concern disclosures has actually been asked as a current issue. Professional liability, litigation and quality control, definitely different because they would not have been within F8. Gathering evidence gathering. We'll look at the structure of this because there are two ways of dealing with this within P7. Usually within question 1. Question 1 is a planning type of question. Therefore, you could easily be asked on any area of the financial statements to detail the core audit work that you would carry out. As well as developing a strategy, you're developing an audit plan. The other form of evidence gathering that often comes up will be a review stage evidence gathering, whereby you are reviewing the working papers, and for a number of issues you have to determine what the issues are and what evidence you would expect to see on the audit file. Again, it's a huge area, very, very wide. You might get pension schemes, IS 19. You might get share-based payments, IFRS 2. You might get segmental reporting. Now, if some of you are not beginning to sweat a little bit, you may be doing so later. But yeah, again, the best way of preparing the technical side of this is to work through as many past questions as possible. Reporting and close down. There was an interesting question that came up very recently in terms of dealing with opening balances. New audit, how do you deal with the opening balances? It was not asked very, or should I say, it was not answered very well. Why not? I've no idea. But the other side of the close down could well be the auditor's report. For whatever particular reason, auditors' reports are hated by students at F8 and is still there with P7. It's a standard question that will come up time and time and time and time again. And technically, do you need to know the detail of the auditor's report? Yes, you do. And in particular, you must understand the difference between an emphasis of matter and an other matter paragraph. Candidates do not. For whatever reason, I just do not understand, I do not appreciate why you guys, or some of you guys, will get these completely mixed up. That's an F8 thing, the difference between emphasis of matter and another matter paragraph. And examples, you should know that. Maybe F8 was a long time ago and you've forgotten it. You should not do that. Okay, the other core areas, the regularity framework, fraud, laws and regulations. Okay, check the past, go onto the ACCA website and look at the past articles. What has come up? Anything on laws and regulations? Anything on related parties, for example? Maybe something on money laundering. That can come up quite a few times, a little bit of theory, but what very often confuses candidates would be that you know the theory, however, the practical technical side is that you do not recognize the clues given to you that this could be a potential money laundering problem. Fine, work through past exam questions and you'll get quite a few of those. I must admit, corporate governance and transnational audit do not tend to come up a lot, but you never know. So just don't ignore those areas. I've talked a lot in just about the core areas. Let's have a look at the specific differences, the technical differences. You must understand the concept of fair value, the application of higher level fair values, stage 3 fair values, the director's guessing fair value, estimation, fair values and estimation. Okay, you're not dealing with a level 1 estimation where you can just go onto the internet, look at the share price and identify the investment value. Check. Related parties, look at past articles on under the F8 syllabus that you took. The procedures and diligence will be looking at those. Interim financial information occasionally comes up, and money laundering. These are all new compared to F8. So these are the areas that you should be concentrating on and hoping that the rest of the F8 you can recall. Due diligence we'll be looking at. Forensic auditing. Okay, that can be connected with identifying a fraud or valuation problems. But that's going to use your auditing skills. Current issues. Read the article. Do research. You should have been doing research on the web. Google a bit, or Chrome, whatever browser you use, in terms of dealing with what current issues there are. IFRS, already pointed that out. With F8, then the IFRS was based on the F3 levels, not the F7, because with the F papers you can take them in any order, and therefore it's possible that somebody might take F8 before they take F7. So it's a fairly low level of IFRS that you need to understand at F8. At P7, you've got the whole lot. Okay, all of the IFRS that have been issued within the time frame for the P7 exam, those are examinable. and bear in mind all of the disclosure requirements that very often come up with those. Okay, do we have any questions on what I've asked so far? I can't see anything coming up. Now, these are fairly straightforward in the sense that the basic ethics will not be different from F8, but what is going to be different will be the way you need to think. So an easy start onto this, because you should be familiar with these type of things. You should be aware of the fundamental principles and the various threats and the concept of the safeguards and the gifts and hospitality, loans and guarantees, financial interests, the fees and pricing. All of these areas can be examined in both F8 and P7. So just looking at this, conflicts of interest and confidentiality, potentially much more interesting at P7, particularly in terms of the conflicts of interest, the type of questions that can come up. But a lot of the key here is to be able to actually recognize that, hey, this is a conflict of interest. How do we need to deal with that? Advertising, I've already mentioned. There are a couple of good questions. I'm not going to be touching upon advertising here, but you should know the key points and the way you can apply this theory, as I have said, is that you want to be able to recognize what those particular points are. Okay, I said about a couple of the questions. Let's have a look. Yes, there was a good question, and this is just not looking at the question, but I think you'll have to excuse me, but it would appear that my system has locked up, so I just need to come out of this. I'm using the wrong pen, so many pens here, but okay, anyway, Neeson, I think was an appropriate question, and that was December 10. Let me just check through my detail that I have here. Apologies, I'm just trying to find if the Neeson is the right question for you. Yes, Neeson & Co., which is looking at advertising. So make sure you definitely work through Neeson & Co. December 10. As I said, there was an earlier question as well on advertising. Interesting here, for example, claim superiority. You cannot claim that you are better than all the rest, for example. You can, provided that you can show. For example, one of the major firms might argue that they are the largest, but on what basis are they the largest? Maybe they are the largest because they audit the most firms within the FT 100, for example. All right, so work through Neeson, December 10. Well, in fact, just make sure you work through absolutely everything. Basis of the fees, fee quotations comes up on a fairly regular basis. Okay, in terms of contingency fees for audit are not allowed. Let's move to have a look at a question. Right, I've just put these questions in without naming them, so if you just excuse me for a second, I need to find out what question we are dealing with. Good. Right, this has come from December 2002. Yes, it's an old question, but it's an excellent question. This is what I'm saying. You need to go through all of the past questions. You'll find these in the archives of the ACCA, but you'll have this question, and if you work through the current batch of questions in terms of P7, there will be more than enough. But I'm using this as a very good example of teaching you now how you got to think, because this is what P7 is about. This is a question I use on introductory courses for my students to get them into the mode of thinking. Right, so December 2002, this is question 5. So let me look. I'll buzz through to find question 5. As I say, all of these questions are totally relevant. Right, fairly short question, 15 marks. All right, so in the current system, that will be an additional 5 marks, so there might be a step 4 coming in here. But you have to comment on the ethical and other professional issues. So other professional issues could be about the timing, it could be about the staffing, and in fact, you have to comment on the issues and the implications for the staffing, the final audit for a year end. Always remember that when you are dealing with P7, then you have to realize that this is on a timed basis. So you guys will be taking P7 in December. So as you're taking it beginning of December, then you might be doing planning for the inventory, and that will be December year end. Or if you've got a September year end, then in December you'll be doing a review. Or if you have, shall we say, a March 2016 year end and it's December, then you may be dealing with an interim stage of the audit. So it's real timing. Right, okay, what I would like you to do is just read through. I'll leave this on the screen if you don't have it within a study question bank, but I'll leave this on the screen for you to read through items 1, 2, and 3, bearing in mind what we've just said. And if you're a little bit concerned about this is going to disappear, then the video, or should I say, there will be recording made, and my understanding that this will be made available to you within 48 hours. So when you've got the recording, you can come back and rework through this question and rethink this question. But just a couple of minutes now, please, to read through that and think. Remember, this is ethics. What are the key points that you are picking up from these 3 points? Okay, that's about the time you should spend in terms of reading this through and trying to understand it. Just before we move into the technical side and picking up on these key points, a couple of questions that have appeared, which is excellent because didn't get too many yesterday on F8. Right, I'll just read through the question because some of you may not actually have or be able to view it. But first of all, first question is, will the question on current issues be included in the form of a separate question or mixed with other questions? It's going to be totally mixed. Sometimes, for example, December-June exam this year or the December exam last year, there were a couple of articles written by the examiner, excellent articles. You must read these articles on quality control. A little bit of digging, because within the article there was quality control references and examples given, and the example came up within the question. So you had to dig around a little bit to understand that this was a current issue. Now, some of you may not even realize that what you're dealing with is a current issue because it's been around for such a long time. Okay, so you do need to do the research and just be able to answer the question. As I say, under the old exam, the 3.1 exam many years ago, question 6 was always the current issue. In this paper, P7, which has been around for a long time now, current issues appear anywhere. Could be section A, could be section B. Right, the next question that came up asks, forensic auditing briefly explained. Yes, I can dig that up and give you a brief explanation of that, but that will be later. So hopefully I'll remember and I'll quickly dive into the material I've got and bring up on screen for you. I wasn't planning to cover forensic auditing because it's not an area that comes up a lot, but I'll certainly touch upon that for you. Okay, back to this question then. Right, what do we need to understand about this question? What are going to be the key issues? How we got to think as a P7 student? Well, first of all, you are an audit manager. That means you make decisions. That's very critical within P7 do not answer a question with a question. Okay, you are the audit manager, therefore you are expected to make a decision. You are expected to justify your decision. You are a firm of chartered certified accountants. Well, that's what is going to be expected. That means that you are subject to the ethical code. You're assigning staff. Well, that relates back to the requirement. So what you should be thinking here, if I'm assigning staff, then I've got to get the right staff in the right place at the right time doing the right things. So I need to make sure that if there are particular risks, then I need higher level quality staff, more experienced staff to be able to deal with those risks. Those of you who are working in firms, I always say to my students, always do what the ACCA expects you to do. So putting high quality staff on may mean a higher price, but that's what the ACCA would expect you to do. Okay, you've got to get sufficient appropriate audit evidence, you've got to understand the business, you've got to assess all the risks, and you've got to devise the audit work program to assess whether or not those risks have led to a material misstatement. You're dealing with a final audit of isthmus. Okay, this was December 02, so that's implying that if you're dealing with a final audit, then that's going to be a December 2002. You're planning the final audit. It's a company listed on a stock exchange. Listed immediately implies higher risk. Your inherent risk is going to be higher for the simple reason it's listed. Also, in terms of the ethical side, then there are various elements that only apply to listed companies. But don't leap onto those immediately. Wait until you see what the detail is that's coming through. You might be thinking, in the current exam, you might be thinking that you cannot prepare the financial statements and audit the financial statements. You cannot prepare the financial statements only in an emergency. Out of interest, for the September 16 exam, that has gone because the ethic rules have changed. Anyway, you are aware of the following matters, 1, 2, and 3. Always useful to read the whole question through because elements in 2 and 3 may have an impact on 1. 1 may have an impact on 2 and 3. Right, Isthmus has recently issued a profits warning. Well, all right, that's okay because that's connected with being a listed company. That is what you would expect. Occasionally, they do issue a profits warning. That would mean that it could be potentially a higher risk, but before you leap off, you need to know why the profits warning has been issued. And also remember here that you're dealing with the ethics side. Keep those points in mind. Right, the company's announced that significant synergies expected from the acquisition of Vanica, a former competitor company, have not materialized. All right, that's not surprising. That's something that very often happens in the practical world. So it may well mean that the profits warning is just bringing back to reality perhaps some of the over-optimistic elements in terms of hoping what would happen when the purchase was made. Okay, moreover, now maybe we're getting to some of the key points because nothing here is really getting too exciting. It's emerged that certain of Vanica's assets are significantly impaired. Right, so that's going to have an impact on the current year end. So this is looking at group situation. So we've got impairment of assets, what particular assets are impaired, what's the audit work they're going to have to carry out on that impairment, what's going to be the potential impact on the profits. So you might be arguing here, depending on the nature of Vanica's assets, that you might need specialists valuations, for example. You might need the use of an auditor's expert to come in. You might need a more senior level of the audit team member to deal with the assets. Non-current assets is something that is usually done on straightforward companies. It's usually done by somebody who's been within the firm for up to about a year, 18 months. It's a fairly low level. But here, the impact on the staffing could mean that you need to have a higher level of staff. Right, the firm's corporate finance department. Okay, so not the audit department, the corporate finance department, assisted by 2 audit trainees, carried out due diligence on behalf of Isthmus before the purchase of Banneker was completed in December 2001. Now that's the first point that many students, when they attempted this question, they did not pick up that the due diligence was carried out a year earlier. Right, let me just switch to my whiteboard. A little bit of exam technique, but it's going to help you to think on this. We need a timeline, maybe a straight line, but okay. We need a timeline. What do we have? We have the current year end, and we have the previous year end. And I'll put the dates in given to you within the exam. Okay, the due diligence, double D, was carried out before the beginning of the audit. Here is where we're planning and dealing with the audit. Whoops. Planning and dealing with the audit. All right, now this is where the ethical and other professional issues starts coming into play. The due diligence was carried out by the corporate finance department of the firm, and there were 2 audit juniors. Involved. Right, so what are the professional issues? And bear in mind that this was done over 1 year ago. Okay, so it's only just emerged that there has been a potential impairment of those assets. So question number 1, were those assets impaired when the due diligence was carried out? Did the due diligence miss that potential impairment, or did the impairment occur during the course of the year? Okay. So what are you going to have to do in terms of other professional issues? You need to review the due diligence file. So even though that file was carried out 12 months ago, you need to go back and review the due diligence file, and you need to review the procedures. So basically, you are going to have to bring in an independent individual, partner level, maybe technical departments, to go through the file to ensure that the file actually stands up. It was well planned, it's due diligence work, appreciate that, but all the firm standards were met, and therefore at the time of the due diligence, there was no risk that somebody missed something. That's going to be critical. You need to think of that. Okay, second point, in terms of the fact that you are looking at an impairment here, what's the impact in terms of, are you going to be sued? What's the legal impact? If you're going to be sued, then immediately, what about your insurance? Professional indemnity insurance. You are going to have to contact your insurance company and explain to them that you are aware of this potential problem, and it could well be that you will be sued. With professional insurance, professional indemnity insurance, any indications, you must inform the insurance company immediately. Just 1 second, I need to refresh my throat again. Okay, we are back. So that's another point that you need to pick up on professional indemnity insurance. Then, what about the 2 audit juniors? Many candidates, when they answered this exam, lambasted that the juniors should never have been on the audit. They were on the due diligence. They were audit. They're the wrong type of people. No, I've done lots of due diligence work. I did lots of due diligence work as an audit junior. It was good fun. It wasn't an audit, but the work is broadly the same. So long as the juniors were capable of doing the work, then there's no reason why they should not be on the work. It's good experience for them to look at a different perspective. So they will have to be briefed, they will have to be supervised, and they will have to be reviewed. Again, reviewing the due diligence file should pick up any particular problems that may be they did the due diligence work on the non-current assets, and maybe they did miss something. But that then begs the question, if they missed it, what about the review? Why did the review miss it as well? All right, so the due diligence happened before the end of the previous year. Next stage in the timeline, the audit for the year end 31/12/2001. If the assets were impaired, why did the audit miss that? So what do we have to do? Look at the prior year audits. Again, if we're dealing with the prior year audit, review the working papers. Very good technical point here in this type of question. Wherever you have done previous work, always think about the need to review the previous work. So we need to review the working papers just to check that the audit file is complete and there's no indication that the impairment had occurred and had been missed. Why? If it had occurred and had been missed, why was it missed? There's always the risk, of course, that there's a self-review issue here, that because a due diligence had taken place, then perhaps a full audit had not taken place and the auditors had relied upon the work of the due diligence. So it's a self-review issue. They didn't carry out a proper audit. That's going to have an impact. Okay, looking at the prior year audit, we can come back and think about the audit juniors again. Were they involved in that prior year audit? It's a good point that perhaps potentially they should not have been, because if they were on the due diligence, keep them from the following audits. So there's no risk of a self-review. If they were involved in the audit, did they do the same sections as they would have done on the due diligence? Again, that's going to be a particular issue that may have resulted in the oversight of the impairment. So more than enough there to pick up the 5 marks. There are 3 issues here, 15 marks in total. So the broad assumption you can make is there'll be 5 marks for each. More than enough, but we've only been talking about the previous year. Going back, professional issues. What about the current year? Don't overlook what we were looking for. And that was the staffing for the final audit of Isthmus. So as far as the staffing of the final audit is concerned, we've got a problem in relation to potentially being sued, so that's going to make it much higher. There is an advocacy threat. Okay, so coming back to looking at the particular threats, advocacy is about anything connected with legal issues. Here we have a potential dispute which is going to involve legal action, so that could be an advocacy threat. So that may well mean that we're going to need a higher level of staff, more senior staff, to be involved. What about the two juniors? Again, it's a very good idea that those two juniors should not be involved in the current year's audit. They should be avoided. If, for whatever particular reasons, they do go back onto that audit, then they must be kept clear of non-current assets. But, as I'm saying, the best thing is that they should not go back at all. Okay, so hopefully you can now see from a technical point, there are quite a lot more issues involved than you potentially think. Right, let's move back to the question. Point number 2. Mercedes is an assistant manager. Okay, as an assistant manager, that's going to be a higher level than a junior, but a lower level than a manager or a partner. But that basically means that there could be a higher risk involved, because Mercedes is indicating that she would be in a position to make higher level decisions as the assistant manager. And she was assigned to the interim audit of ISMUS. No date, but that means maybe that was held back in September, October, November time, for example. Since the interim audit, she's inherited $5,001 shares. Okay, so that's interesting. So that should start immediately, and you should start immediately thinking, hang on, here we have a self-interest, we have an investment, we have a member of the audit team who has this investment. They should not be a member of the audit, they should not be involved in terms of the year end. Okay, that's fine, but, you're not going to get 5 marks just for saying that. All right, she told you she has no intention of selling the shares. So we've got a little bit of a strong character here. Until the share price recovers from the fall to 195, which followed the profit warning. Well, okay. This is what I've said about reading the whole thing through, so you can check, because here we have 7.95. So that's telling you that there's a $6, put a dollar sign in, there's a $6 difference, therefore it's worth $30,000. Is that, or is that not, material to Mercedes? That's the question. All right. So where will the other marks be coming from? Let's go back to the whiteboard and think. Just think about it. Here we're dealing with investments, shares. Be careful, because if you're looking at shares investments, then the partner cannot hold shares in any of the clients, full stop. Other staff, including managers, they can, but they cannot be involved in the audit. So they will have to be removed from the audit. So we've got a self-interest threat, we're looking at the partner, we're looking at Mercedes, who is an other. She may have integrity, she may be independent in mind, but she does not appear to be independent. So basically, Mercedes is going to have to be removed, or at least she will not be planned into the year-end audit. All right, is that still worth 5 marks? Look at what the question is about. She inherited the shares. She didn't win them, she didn't buy them, she inherited. So That begs the question, did Mercedes know that somebody in her family held the shares? If the answer is yes, then the next question after that is, did Mercedes report that she may not be independent because of the problem of a family member, an aunt, an uncle, brother, sister, parents maybe, of holding the shares? If the answer is no, then we've got a quality control issue, because if she did not, well, I say quality control, if she did not report, then maybe she's facing the sack, dismissal in this case, rather than the quality control. Let me just take that quality control out. I'm ahead of myself here. Did Mercedes report? No, she should have reported. Every year, professional accountants have to confirm independence, and they have to confirm independence before they go on to the audit of a client. So here, she was in breach of her ethical guidelines and the guidelines of the firm, and that's going to be a dismissal. If she did report that somebody had the shares and she could inherit those shares, then that's a quality control issue, because she should not have been involved in the audit. She should not have gone on to the interim audit. Full stop. All right, so there's a number of issues there. Now you're going to be looking at getting those 5 marks, but we still have not yet finished in terms of the technical side of this, because if I spelt that correctly, she has no intention of disposing of the shares, of selling the shares. Is that going to be a conflict with the ethical guidelines of the firm? She's refusing to sell the shares. Right, be careful, because she's not a partner. So in this case, on the ACCA rule, she's not a partner. So is that okay? Is it okay to keep? But what are the firm's rules? Just about all of the major firms, the first tier, second tier firms, top 20, top 40 firms, state that audit staff cannot hold shares in any of their clients. So they bring the partner rules down. Okay, that's not a specific requirement of the ACCA ethical code, but it's something that they do to be seen to be as independent as possible. Okay, so if Mercedes knew that an aunt or an uncle held the shares, then Mercedes is a junior, she's not a partner, and she doesn't hold the shares, so there's no need for the mother, the father, the aunt, the uncle to sell the shares, but Mercedes would have to declare it. She would not then be involved in the audit. It's just the extrapolation. This is just the interpretation, the analysis at a P7 level, that if she's so adamant that she has no intention of selling the shares, why? Probably, possibly, maybe, because the firm has these specific requirements of selling the shares, and therefore she's going against the firm's guidelines. Okay, so pick up on that, and that's going to get you, well, if you pick up on that level, then you're into what I would call the prize level. So implications for the staffing: remove Mercedes. Don't forget to come up with that conclusion at the end. Okay, the third part of this, Anthony. Let me just clear off some of the elements here. So we've got to clear on Anthony. Come on, different colour to Anthony. Anthony is an audit senior. Again, lower than the assistant manager. Lower risk. Been assigned to the audit of business since joining the firm nearly 3 years ago. Don't leap on the bandwagon. Don't start talking about rotation. Don't start talking about lack of independence being too close familiarity. It's quite common for a member of the audit team to go in year 1 and then come back in year 3 as a senior. That's very common. They've got the experience, they're gaining the experience. That's quite useful. Rotation is about partners and senior managers. Anthony here is an audit senior. Right, he's confided to you that his father owned 1001 shares in Isthmus. So he's declared it. So everything is known about that. So that's okay. But that then begs the question again about the quality control procedures. If the firm knew that the father owned 1001 shares, then why did he become involved in the audit? He should not have been involved in the audit because of the father's connection. Again, you can argue here that if he's only just declared that, then there should be appropriate disciplinary action taken against Anthony for not declaring that. But it's of a lower risk. Again, this depends on the firm's procedures. It's of a lower risk because Anthony is lower down the decision-making chain. So it's highly unlikely that Anthony is going to be making decisions that would impact the audit opinion. Bear in mind that his work would have been reviewed by the manager and the high level at the partner. Right, so moving on. His father sold them only days before the profits warning. Okay, so only days before the profits warning at a share price of $7.95. Question: why did he sell them? Was it just pure coincidence? That could be the situation. So there's nothing untoward there. Or did he find out? How could he have found out? Well, the possibility there is he found out because inadvertently Anthony left some confidential papers. So we're moving into confidentiality. It could be that his father went through Anthony's audit bag or his computer, gained access to the computer, which then begs the question, how did he do that? Because the computer should have been password protected. You can pick up on these points, but keep in mind what the question is about. It could even be strange enough that Anthony talked in his sleep about it. That could be sad if you're talking about the audit in your sleep, but okay, maybe this happens. So there's a touch of confidentiality and access to the working papers here. Of course, it could be that Anthony actually told him. And what I said earlier about reading the whole part before leaping in, you are assured that Anthony did not previously know that his father had the shares. Now, I talked a few minutes ago about potential disciplinary procedures. If you went down that route, that is explained, that's showing the marker that you haven't read the question and you haven't thought it through. So Anthony did not know that his father had the shares, so there will be no disciplinary procedures against Anthony on the basis of knowing that his father had the shares. So those will be the key points in terms of picking up on the father and Anthony. Implication for the staffing? Well, in this case, with the implication of the staffing, Anthony should not be involved. That would certainly be my situation in this one. He didn't previously know that his father had the shares, but that aside, there are some issues here because his father may have been involved in insider dealing, insider trading. So to be absolutely certain that there can be no comeback to the firm, then I suggest here that Anthony should not go back onto the audit until at least perhaps when he's an assistant manager. for example, and would go back. Right. Anybody have any questions just on the ethics? There's nothing particularly technical about the ethical side of it from F8, but you've just got to be much more depth, much more out of the box thinking, and hopefully explain that and going through that has given you an insight into how you should be thinking, and in particular, for example, if we're looking at the whiteboard, the use of timelines. Right, just picking up on a couple of the questions that have come through. Well, sorry, it's one question, but two questions related to the same subject. How are IFRS tested at P7 level? They're not specifically tested per se as they are at P2, but it's going to be the audit requirements. So, for example, measurement or remeasurement, recognition. How would you audit the recognition of a financial instrument? How would you audit depreciation? How would you audit the potential impairments? How would you audit disclosure requirements? Now, that could be relatively straightforward because you could say, hey, I could have a disclosure checklist. Well, that's okay in the sense of is X, Y, Z disclosed, but remember now with IFRS, it's getting very, very discursive. It's getting very much about risk analysis. So a lot of the disclosures are going to relate to directors' belief, directors' impressions, expectations, shall we say. One question, just to ask yourself. Sorry about that, I just had a message coming up saying my audio had been lost, but you should now be able to hear me. Hopefully that's the case. In terms of the IFRS, sorry, I've just lost my track there with the audio coming on or off. Right, yes, question for you. How many of you have actually downloaded a set of financial statements, say from the FT, say Vodafone or Rolls-Royce, the aero engine manufacturers are the two I use, and how many of you have read through them and say, well, how on earth am I going to audit that? It may be a bit too late at this stage, but it's always a good idea to have a look at the real things rather than just relying upon any extracts that are given to you within a set of financial statements or extracts within a study system. Have a look at the real things and ask yourself, how would you audit the discursive elements? One quick question has come up about Anthony. Why would Anthony not be part of the audit team? Anthony could be part of the audit team if everything he says is perfectly correct. But there is doubt because his father found out somehow. Anthony has been tinged a little bit, perhaps. So why I am suggesting that Anthony would not be involved in the audit team is to be as safe as possible, to be seen to be as independent as possible. Because of his father, Anthony is connected obviously with his father, so even though he may be perfectly innocent, he's got to be seen to be innocent. And the audit firm's got to be seen to be innocent. So in that case, I would not put him back onto the audit for a year or two. So overall, another question's come up. What are the implications of these three matters? Well, the implications would be that basically, let's just go back and check on those three matters, what we have here. Right, the profits warning and the detail I've gone through those, that's going to increase higher risk. So the juniors should not go back onto the audit because remember you are dealing here with the implications for the staffing. So the juniors should not go back, Mercedes should not go back, and I'm suggesting that the audit seniors should not go back. So you are looking at putting on a new audit team that it can be seen to be completely independent. You are also going to be looking at because of the issues over independence, or perhaps reviewing the procedures, the quality control procedures that the firm would have for the independence, because there's significant risk there on independence, and confirming to everybody, reminding everybody, maybe having a training session. That's something else that often comes up within P7, to have a training session to remind everybody of what independence is about. Okay, another question came up talking about thinking about the laws and regulations within the particular jurisdiction. That's a difficult one because it depends on the jurisdiction that you are in. But the number one to go with is going to be the ACCA Code of Ethics. Run with the ACCA Code of Ethics. If the jurisdiction that you are in overrules any aspects of the ACCA, then in the exam mention that and say what it is. But you're always looking at the higher of the two. So if your jurisdiction has a higher ethical requirement, then the higher ethical requirement must be applied. Right, you can now see, because we've now been doing this for an hour and a half just on this one area, but this is what I'm saying, that in terms of covering this within 4 hours, it's impossible. It's an impossible task. All right, but let's deal with the impossible. I love the impossible. Right, let's move on. Any questions? We can come back at the end, please. Right, those were the Code of Ethics. We looked at that. Right, business risk. I want to pick up on business risk for the simple reason that you will have done audit risk at F8, and you will have covered business risk at P1. But the question 1, the risk questions within question 1 are going to be based around business risk, risk of material misstatement, or audit risk. And question 1 is a key question. It's 35 marks. So I want to concentrate on a typical risk question and a business risk question, because you will not have had this style before in relation to F8 or in relation to P1. Right, you should understand what business risk is about. Those of you who use the BECA system, then you may well recognize this from the P1 material. So you need to understand what business risk is, you need to understand the types of risk, you need to understand the TARA, transfer, avoid, reduce, and accept. I'm not saying that you will use TARA, but it can form the basis for your answer in terms of what business risk is about. Do not get confused with business risk from the business perspective and the business risk audit approach. Business risk audit approach is connected with audit risk. I'll put the right color on. Is connected with audit risk. Just excuse me, my pen has frozen up again, so I need to come back. Yes. Right, audit risk, if you remember, was inherent risk, control risk, and detection risk. The business risk approach is dealing with inherent risk and control risk. So the business risk approach is about ISA 315. Understanding the business, its environments and controls, the design of the control, the implementation of the control. Understand what can go wrong that can create the material errors, and as this is P7, do not forget, of course, that the material errors could well be in disclosures. Some disclosures may have been completely missed out, narrative disclosures, chatty disclosures. Some of them may be deliberately misleading to fudge over, smooth over, smog over a particular issue. So that would be a misstatement. Okay, so once you know what can go wrong, then you need to develop your audit strategy and plan, your response, ISA. Let me just put these up here. So I'm saying this is ISA 315. And here we have ISA 330. Okay, so that's the concept of the business risk approach in determining inherent risk and control risk of the audit risk model. Don't get business risk and those particular risks mixed up. Okay, so let's just come back to business risk. Section 1 here, business risk. This is what's going to be coming up in relation to the exam. Question 1, any form of risk, but I'm concentrating on business risk. So let's go back to a question. Right, the question I'm looking at is in June 09. Notice that these questions may be a little bit old. I'm not using the current question because I think students tend to do the questions and they work backwards from the latest backwards. So I'm picking up some questions here that maybe you'll not get around to dealing with, but I think these questions are, some of them are excellent in terms of demonstrating the points. That's what I'm interested in. So we're dealing with June 2009, and this is question 1. Now, the style of the question, as you can see here, is a lot. There's a lot of information here. Right, because I've taken this directly from a June 09, notice that the style of the question is slightly different. It's not distracting from the benefit of this question, but the requirements, these requirements here, A and B, will be in the form of an email or a memorandum that will be at the beginning of the question. So you'll get a brief introduction to what the question is, then you'll get a memo coming in somewhere around about here, for example, an email that would embed the requirements. If you're looking at the current exams, that's what you would have. Okay, and certainly if you're looking, for example, at the Becker revision question bank, most of those would have these requirements in the form of a memo or email. But I've taken this directly from the exam itself because some of you may be downloading off the ACCA website. Right, okay, the first point is that we need briefing notes, and the more important point is we've got to evaluate the business risks facing champers using the information provided. I want you for this exercise to concentrate on part B. Identify and explain the aspects of a client business. Well, that's ISA 315. Okay, so part A is about 315. Very quickly, what you'll need, for example, will be the industry, the regularity and other external factors, the applicable financial reporting framework, the nature of the entity, its accounting policies, the objectives, the strategy, the related business risks, the financial performance, the laws, the regulations that it operates in, the use of internal control, what internal controls are like. Standard 315 breakdown. Okay, and then part 2 of this, recommend the procedures, inquiries, observation, inspection, and something that students very often forget, analytical procedures. Analytical procedures will be used at the planning stage to identify potential areas where there could be material misstatements. Okay, what I want you to do, and this is going to be a little bit difficult in terms of doing this, but because we've got the detail here. Right, first of all, I'm just going to put this up. Can you just read through that to familiarize yourself? I'll move this down in a minute and I'll complete it in a minute. Those of you who have got the question, read through the question because there's a lot of detail here. Okay, so I'll just leave that up for a minute, then I'll move on to the next element. Okay, I'll just move this down for a sec so you can get an idea of the business segments. So with the business segment, we've got a Happy Monkey, we've got a Quick Bite, a City Sizzler, and Green George. So if you'd just like to read through that for a minute or two. Okay, hopefully you've got the idea now. So just a quick reminder, laws and regulations, and evaluate the business risks facing Champers. Okay, as I say, this is a very typical question 1, which under the current examination structure is worth 35 marks. If you can get a significant proportion of those marks, then you are well on the way to passing. And believe it or not, there can be usually a ratio of 1.5 to 2 in terms of for every mark that is required in a question, there are 2 and even 3 marks available in the answer. So you could get half of it wrong compared to the answer and still pass with a full 100%. Right, but I emphasize again, practice, practice, practice. Make sure you understand the way the examiner thinks, because a lot in this is not really what I would call significantly technical. A lot of it is just understanding and common sense and reading the detail carefully. In the exam, you will be utilizing the vast majority of your 15 minutes reading and planning time looking through this question 1. But that's exam technique. Let's get back to the practical technical, the technical practical way of dealing with it. Right, let's pick up on these points. Champers & Co, number of restaurants. This is a business risk. There's your first clue. If this is a business risk, what do we mean by business risk? Any event that could stop the business doing the business. Any event that could stop the business achieving its objective. Most people immediately think of going concern. Be careful with going concern. Build up the going concern. Don't throw it in just for the sake of saying, hey, going concern. Build it up. This is a professional level paper, remember. But business risk, restaurants, health and safety, straight away. Okay, so in that context, health and safety regulations. They operate in a very highly regulated industry, so there are a huge number of laws and regulations, and non-compliance with any health and safety regulations could actually mean that the business, the restaurant, is closed down. So here, that's health and safety in terms of the food. You don't want to be poisoning your guests. Health and safety in terms of the kitchens. Health and safety in terms of the restaurants itself. So you should pick up on that. Right. The company's strategy offer a variety of different dining experiences. So that may be diversification, that may be a good thing, because if something goes wrong somewhere, then it may well not have an overall impact. But reputation is another situation. If I can squeeze that in. Reputational risk. Just 1 second. I think I'm going to see if I can move that in. Right, reputation. That's better. So it's very highly customer orientated. There are a variety of different dining experiences, that's fine, but if the reputation of one of the dining experiences is bad, that can overspill in terms of the brand names. Then maximizing market share in a competitive business. So that's a business risk, that they are unable to maximize the market share. You're a senior audit manager, so you have to make the decisions. That's okay. You're planning the audit for the year end. We have extracts of information here. Right. What particular information did you pick up? The examiner's giving you this information for specific reasons. Right, total company revenue has increased. But in terms of the percentage of the company revenue, how much has that increased by? Just doing a quick calculation here myself. So we're talking about 11% increase. Okay, right, let's have a look at the Happy Monkey, the Quick Fit, the City Sizzler, and the Green George. All right, Happy Monkeys have gone from 660 up to 800, so they have increased. That's okay. You think, oh, you're happy there, but what percentage are we dealing with? There were 660 of the 1350 before, so they were about 48% before. And if we are dealing with the current year, then it's increased, it's 53%. So in terms of the Happy Monkey Family Bistro, overall it's increasing, but over 50% of your revenue is coming from one business segment. So if the Happy Monkeys become very unhappy, that's going to create a lot of problems for your business. If the worst case scenario, if the Happy Monkeys go, you've lost over 50% of your business. Did you think about that? We have the quick bite outlets, or the quick bite outlets have decreased from 400 down to 375. So it's a decreasing market in that case. But if you look at the percentage, then it's decreasing in terms of the percentage of the total turnover. City Sizzlers, they're holding their own from 290 up to 300, but again, it's decreasing in terms of the total revenue. Green George is a new starter. We need to know more detail about Green George and what the intention would be for the future with the Green George. Company profit is declining on an increasing turnover. So what's happening there? Are we coming under attack on our margins because it's a very highly competitive situation, or are there particular non-operational costs that have increased in the current year? Company total assets are increasing, but what about the cash? The cash is decreasing a lot. Why are they, or where has the money gone, should I say? Okay, now let's look at the individual business sector itself to see what specific points are. We just picked up on a number of overall points, but what can we say? Right, Happy Monkey. Most of the restaurants are located in residential areas. We've got a large children's play area. Health and safety. You don't want the children having accidents. Climbing frames and slides. Crash facility. They can leave the children and the children will be happy little monkeys and the parents will be happy little monkeys, I guess. But there's been some media criticism. Media criticism is going to hit a reputation, bad publicity. And bear in mind, with the Happy Monkey is tying up 53%. Can you see now the link that we are making, that you have to make here? Okay, what happened? One of the Happy Monkeys restaurants was closed for 3 weeks following a health and safety inspection, breaches in the hygiene standards of the kitchen. So basically what's happening is if we don't damage your children on the play area, we can stand a chance of poisoning the parents, which is rather strange given that I ended up with food poisoning yesterday. Right, must admit it was not a Happy Monkey that I went to eat in. Anyway, but this just says one of the Happy Monkeys was closed. But hygiene standards should be universal throughout the entire organization, throughout all of the Happy Monkeys. The whole process should be exactly the same. Look at McDonald's, look at Kentucky Fried Chicken, or look at the similar variants, the similar type of fast food restaurants, maybe vegetarian fast food restaurants that you have in your country. You may not have a McDonald's, or they may do non-meat variations. But the standard is exactly the same. So we've got a standard problem here. Could there be problems elsewhere? Plus, of course, if one restaurant has been hit by health and safety inspection, they found problems, you stand a risk that all of the restaurants of the Happy Monkey will then be subject to health and safety inspections. Okay, so additionally in terms of the Happy Monkey, the quick bite, fast food, next to busy roads, railway stations, airports. Okay, there's a significant marketing campaign to support the quick bite brand name, an expense of 150 million in relation to the advertising. Well, okay, that's going to explain the drop in terms of the company profit before tax, for example. Certainly explains a lot of it. But if we're dealing with a quick bite, notice here that quick bite has gone down from 400 down to 375. So the potential risk there is that the marketing is not working. Why? It may need to have a review. It's a significant marketing campaign, not being very successful at the moment. We need to look as to when the marketing campaign started. Okay, if it started late in the year, then we need to look at the monthly statistics on that to see if it has had any particular impact, or maybe the impact will come through in the following year. In January 2009, the company started to provide nutritional information on its menu. Excuse me, my throat is going a little crazy here. 50% of the revenue of this business segment is derived from the sale of chuckle boxes. So that definitely sounds like a McDonald's type of thing. Self-contained children's meal, which contain a small toy. Hang on a second. What can we say here about laws and regulations? Advertising regulations forbid the advertising of food in a manner specifically aimed at children. They're coming in from September 2009. Okay, what's the company's year end that we're dealing with here? May 2009. So it's not happened yet, but it could well be with a quick bite outlet. A business risk is that 50% of the revenue stands a chance of disappearing. So they are going to have to rethink how they can still maintain that 50%. That's going to be a significant business risk. So a business risk is revenue reduction for the quick bite chain. They are going to have to rethink their strategies over the children's meal and in terms of the advertising. City Sizzler, more sophisticated, meaning more expense, but maybe the people who dine at the City Sizzler have more money to spend. High quality food in luxurious surroundings. That's going to cost a lot of money to maintain. 250 City Sizzlers, they're expanding to 500. Prime city locations, they're completely refurbished every 2 years. So they are looking at doubling by May 2010. Again, back to the year end. Sorry about that. So we're looking at doubling it in the following year. Where's the money coming from? Company cash at bank has reduced. Company net assets have increased, but are we going to have to fund this from further loans? But the business is going to be hitting problems in terms of the quick bite outlets, and maybe a problem if they cannot sort out the Happy Monkey situation in terms of the children's play areas, because there could be a huge amount of money having to be spent to bring the play areas up to standard. There may need to be money spent in terms of overcoming the breaches in the hygiene standards in the kitchen. So City Sizzlers is indicating a cash flow problem. Do they need to go from 250 up to 500? Do they need to be completely refurbished every 2 years? Can they cut back on the expansion, given the state of the economy. Look at the current situation as well. So the economy may be declining in your part of the world. Look at that state, and then can they extend the refurbishment to 3 or 4 years? What can they do to maintain the standards without spending money? Green George, recent addition, 30 restaurants. Again, affluent residential areas. So they're looking at people who have the money, but economic situation, are they going to be hit by affluence not spending the money? Eco-friendly food, guaranteed to be free from artificial flavorings and colorings. Environmental, sustainable manner. What are you thinking there? This is a restaurant. They are saying that it's eco-friendly, environmentally sustainable, and that it's guaranteed to be free from artificial flavoring and coloring. You may read that and say, fine, great, but all it's going to need is the mystery eater. They're setting themselves up to be tested. Think of the VW scandal. Think of the problems they're having with the diesel fuel. How did that happen? Because a couple of researchers researched their cars, drove their cars, a number of their cars around America, and discovered that the emissions from the diesel cars nowhere near matched what they stated under real life conditions. It just didn't make sense. So in this situation, what's to stop somebody coming in, ordering the mill, and then slipping the mill into plastic bags, taking them off to be tested in laboratories? Environmentally sustainable manner. How can they prove that? Investigators could come in and prove that it's not environmentally sustainable. By saying this, they have to be very, very careful. The huge business risk is bad reputation, that they do not provide food that is free from artificial flavoring, and they do not, for example, use environmental sustainable sources. That can be a huge problem. Right, 30 restaurants have been newly constructed, capitalised at 210. All directly attributable costs, borrowing costs have been capitalised, so the loans have been taken out. That's indicating where the finance is potentially coming from, because the cash is going down. They're planning to double the number of Green George cafes operating within the next 12 months. So again, as far as Green George is concerned, there is significant problems in relation to the potential sources of where they can get the cash from. If they're going to carry out this expansion, they are going to have to borrow money significantly. So we've got the Green George cafes and we've got the City Sizzler cafes, the expansion plans. Huge problem. Profit before tax has decreased. That's gone down by some 13%, despite the fact the revenue's gone up by 11%. Business risk there is that going to be sustainable? How are the costs being managed? And the clue for that is given to you in the minimum wage regulation. 1/3 of Champa's employees earn the minimum wage. So the minimum wage is being increased by 15%. What's going to happen to the other 2/3? Well, the other 2/3 are suddenly going to find their differentials eroded, and that means that they may want also to have an increase of 15%. So that can impact the profit before tax reduction even further. So there is a cash problem, potential cash problem here. I've mentioned cash, cash and cash. The whole business is based around cash. Business risk on cash is that it can be very easy to disappear. There's a high risk of fraud. So the cash can be misappropriated by staff. There's a high risk of the produce being fraudulently used. So the restaurants could be buying produce and the staff could be taking that produce away to sell on a Saturday morning market somewhere or a Friday morning market somewhere. So overall, the business is facing some financial difficulties. All of those can relate to the ultimate business risk, leading through to the ultimate financial statement risk of going concern. Okay, that's giving you an idea in terms of the way you need to think with these type of questions, and how a lot of these questions are not technical in nature, but it's just being able to pick up on the clues that are given. These are practical background detail, practical understanding. Some of it can be common sense, I suppose. But the best way is if you are not working in such an environment, if you're at a study school, if you're doing the ACCA full time, then the best way of dealing with this at this stage, if you haven't kept up with what is happening, what has been happening in the finance world and the business world, then the best way now, from now to the exam, is to work through again, and again. I always repeat this. Every single past examination question, especially question 1 and question 2, and then always question 3, 4, and 5. But concentrate on question 1s. Make sure you get an in-depth coverage of business risk, risk of material misstatement, audit risk. Right, I'm about 10 minutes over the allotted time of halfway through. So let's call the break now for 20 minutes. And when we come back after 20 minutes, we'll have another look at an interesting type of thinking approach, and that's going to be due diligence. Okay, thank you very much. Okay, got some questions. I was going back to the partner and the shares. Right, we talked about judicial laws. Okay, the next question that came up was that audit evidence is the essential part in paper, but in past paper there are very varied cases. Exactly, they are extremely varied. Okay, for audit evidence, for example, insurance policy. Is there any tip to tackle these type of questions about what this connection was about? Okay, let me just repeat the question again. Audit evidence is the essential part of the paper. There are very many varied cases. Yes, there are a huge number of varied cases. Is there any tip to tackle these type of questions? The best tip is, quite frankly, that you have to work through as many past examination questions as you can. I'm being serious. Certainly within like the Becker study system, there's a lot of detail in there on the various audit evidence that you need, but seriously, the best way of dealing with this is that you will work through every past question, and that will certainly get you an idea. You mentioned here about an insurance policy. For example, if there's an insurance claim, then you will need to know what the insurance policy is to identify exactly what the liability of the claim could be. If you are dealing with a newspaper report, then you would want a copy of the newspaper report to be on file. If you're talking about an investment in a company's shares, then you'd want evidence to be on file of the value of that investment. So that may well be a stock exchange listing, for example. If you're talking about, another example I can think of very quickly, is if you're talking about an investment that's gone into liquidation, then you'll be wanting to look at the liquidator's report. Okay, so again, the more questions you work through, then the greater the range of ideas you are going to get. To be serious, I think you're going to reduce your chances quite substantially if you have not worked through at least the last 5 years, 10 exams, 12 exams, 15 exams. That's been quite serious. Okay, next question. If a partner has shares of a client, then can we conduct the audit? Well, the answer to that is no. The partners have to be completely and utterly independent of any of their clients. I say their clients, or the firm's clients, not just the clients that they are the partners, the audit partners for, but any client. And that includes international clients as well. Okay, the partner has to be totally independent. Then there was another question coming back to QuickBite. How is 50% of revenue of QuickBite a business risk? Well, 50% is half of your revenue. So if QuickBite disappears, then 50% of your revenue is going to disappear. Can you survive if 50% of your revenue streams disappear? Look upon it similarly as a customer. So this is, if you like, is a segmental element, but what if you have a major customer? If a major customer goes into liquidation and stops buying from you for whatever reason, will you be able to survive? The answer might be yes, but it's still a business risk, because you'll then have to take appropriate action to try and ensure that QuickBite does not have to close down because of various laws and regulations, or children having accidents, or being hit by a reputation risk. Okay, I said before I nearly said the lunch break, but not quite the lunch break. I said before the break that I was going to be moving in to look at due diligence. There's a short little element here on due diligence, but this is going to be effectively a review. Due diligence can cover a wide range from just a one-off area, for example, collectability of debts, right the way through to virtually a full audit that you wish to identify and contain the risks associated with a particular transaction, which is usually buying a business. Okay, audited financial statements can be relatively straightforward. They've been audited already, so hopefully you can rely on the audited financial statements, but it's the skeletons in the cupboard, it's the off-balance sheet items, it's the culture of the business, it's the risk that key members of the team will leave, it's a risk that key customers will leave if a business changed hands. The more a business is human resource, then the greater the risk that people will leave that business. Talks here about a review of tax returns, but if you, for example, look at any accountancy practice, financial services practice, then auditors are auditors. They can go and they can leave. That's okay. But if you look at the tax partner, then the tax partner may well be, I won't say one of the family, but the tax partner could well be key, and therefore the people will tend to go with the person. If the tax partner leaves, they go with that person. Just excuse me for 1 second. Right, apologies for that. That's better. My throat is back, getting back to normal again. So here, if there's a personal relationship with anybody within the business, they will go. It's the same with the tutor business, for example, that if an office of one of the tutoring firms leaves, then there's a risk that the clients will go because they know the tutors, they like the way the business is done. So there is a risk that they will follow that particular person. So due diligence is really trying to find out particular problems. It could also be about what happens if we take over about contracts. Are there golden handcuffs? Are there golden goodbyes? Are there poison pills? All these type of things that the due diligence will hopefully be able to find. It's just trying to find the things that are behind the balance sheet. It's looking at the human resource. It's looking at the culture of the business. For example, because one of the major reasons why businesses fail, or mergers fail, should I say, is because of poor culture mix, especially if you're dealing with an overseas culture, buying into an overseas market. Okay, so let's have a look at a question, and this is more of a recent question. This is December 2013, and it's question 2 in December 13. Now, question 2 is in section B. When this question came up, it did create a significant buzz for the simple reason that candidates didn't like it because it was due diligence and it was compulsory. And due diligence in the past has always been part of section B. But there's no reason why it could not be part of section A. It's a core area. So if it's part of section B, they could have skipped it if they wanted to. But, so they were caught out. Right, so let's have a look then at this particular question. So we can find the requirements. Respond to the request from Mark Clear. So this is the typical news style buried within the background scenario will be the requirement. Respond to the request. So let's see what request is. To help me brief the other directors and using the information I have provided, I want 3 benefits for a due diligence. Okay, I've talked about the idea of due diligence. We can quickly look at that. I'm not concerned about that, but 3 benefits, 6 marks, 2 marks each. All right, so 3 clear points explaining what due diligence is about will get you should be able to get you the maximum of the 6 marks. That was relatively easy. A lot of students knew what that was about. But identify and explain the matters you would focus on in your due diligence review and recommend additional information that you will need to perform your work. Okay, so there's a key point here. We have an and in there. If you didn't put the and in, then you could have lost quite a lot of marks. Just 1 second, I need to, okay, right, and recommend the additional information. If you didn't do the and, you could lose up to your 8 marks. That's going to make things difficult. Okay, identify, explain the matters, and recommend. I just leave that first paragraph up there, or first half of the requirement up there for a minute or 2 for you to read through to get an idea of what the question is about. Okay, let's just move on to the rest of the information. These are the extracts from the financial statements. Okay, let's see what we can do with this and the way you should be approaching it, bearing in mind that we're looking at the request from Mark Clear. I say we want to move on to part B. Okay, the benefits of due diligence part A is something that is purely a learn and apply type of thing, so I'm not going to be too excited about that at this level. Right, so what do we know? We've got company background. It was established 4 years ago by 2 university graduates, Vic and Lou, who secured funds from a venture capitalist company to set up the company. So straight away from that point, and let me just break that down here, we want to know who are Vic and who are Vic and Lou, and what is the importance of BizGrow to the business. What's the nature of the involvement of BizGrow within the business. We know what venture capitalists do. They provide equity when a company is set up, and they look for an exit at some stage. So exactly when are they planning this exit? Are there any particular tie-ins with BizGrow and Miz & Co? Okay, so we just need to understand the background and when, because you're looking at investing in this, exactly when would BizGrow go? Are there any particular problems with BizGrow there? Right, Vic and Lou created a new type of website which has proven extremely popular website interface and led to the company growing rapidly and building a good reputation. They continue to innovate and won rewards for website. Vic and Lou have a minority shareholding in Mizzen, which ties in with the fact of BizGrow. Okay, so if you're looking at moving in, then presumably you'll be looking at buying out BizGrow. You need to find that. However, the point that picking up here is that these two individuals appear to have good, shall we say, good nous in terms of dealing with website interfaces. They continue to innovate. So the company is around Vic and Lou. What would happen if Vic and Lou left the business? What if they sold out the business? If, for example, you are planning to buy 100% of the business, so that will be from BizGrow and Vic and Lou, then the business may well decline because you've got Vic and Lou's intellectual property here. So how important are Vic and Lou to the business? And how can you try and keep Vic and Lou involved? Because without their expertise, the acquisition may just not be worthwhile. Mizzen employs 50 people. Okay, so again, of those 50 people, how many of those people are going to be critical in terms of the skills and expertise? What if the business is taken over? What if some of those skilled individuals left? What do we need to do to be able to try and keep those people involved? They operate from premises owned by BizGrow, for which there's a nominal rent is paid annually. Well, okay, BizGrow is going to get their claim back on that rent somehow in terms of the potential money they take out, or the exit clause may well involve some form of buyout. So, as the business is owned by BizGrow, BizGrow is the venture capitalist. If Mizzen is taken over, would the BizGrow still allow them to use the premises? Highly unlikely. So due diligence is going to be about finding out exactly what the arrangement is in connection with the premises. Because presumably the worst case scenario could well be that new premises will have to be found. If there is a nominal rent of 1,000, how long is that for? It may not be material, but there might be a form of buyout if there is a rental agreement that would need to be broken. The company uses few assets other than fixtures and fittings, but that's looking at the assets in terms of computer equipment, etc. So what about intangible assets? What is going to be the worth of Vic and Lou? What is going to be the worth of the website interface? That's not going to be a tangible asset, that's going to be an intangible asset. So potentially there's going to be a lot of internally generated intangible assets. Those individual assets are not going to be recognized within the financial statements, but they are going to have to be valued in terms of finding out what the cost of taking over Mizzen is going to be. So how do you measure it? It could be very difficult. It's likely to inform some form of expert in terms of dealing with the valuation. There's a lot of corporate customers picking up here. They maintain websites for corporate customers. So again, tying into intangible assets, what's the value of those corporate customers? What's the risk of the corporate customers leaving the business? Try again. How sustainable is this revenue stream? And in fact, how sustainable will be all of the revenue streams? Could there be a risk that the customers will go, especially if Vic and Lou go, the customers will follow Vic and Lou because they have the innovative brains, they have the intellectual property. Okay, there's a one-off fee for its customers for the initial development of a website and maintaining the website for 2 years. They can choose to pay another one-off fee, average 2,000. All right, so coming back to a little bit of IFRS here, then exactly what is going to be the policy, the accounting policy on revenue recognition? And bear in mind now that we have IFRS 15 in terms of revenue generated from customer contracts to consider. So it may well be that when you are looking at the profit of the business, that they are recognizing upfront the revenue rather than an appropriate revenue of meeting the criteria of IFRS 15 and matching that revenue when the revenue has been earned. We have a subscription-based website, access to technical material for computer specialists. All right. What are the rights to that technical material? There's an annual fee of $250, gives unlimited access to the website, 30% of Mizzen's total revenue. Are there any rights that have to be paid in relation to that technical material? So in that case, what exactly, we have income coming in of an annual fee of $250, unlimited access, but who generates that technical material? Who validates the technical material? How much of that technical material is used? Which is the best technical material to be used? We built up several customer databases, which for a fee to other companies for marketing purposes. What could happen if there was a takeover? Would the other companies still wish to access those customer databases? It's the smallest revenue stream, approximately 20%. So what could be the impact if the company, if taking over changes the policy and the customer database, which is, as we've identified, as an intangible asset and therefore has a value, or should have a value, would that access or would the availability of those customer databases be one of the potential options to continue? If we look at the position in terms of the financial, is there anything that strikes in terms of what is the problem? We've got increasing revenue over the 5 years. It will be interesting to see the projections for that revenue as to whether or not those revenues are likely to continue. What can we say about the operating expenses? Well, if we look at the operating expenses, we have 2,000 or 2,010,000, but that's only just increased by 108,000, whereas the revenue stream has increased quite substantially. Is that anything odd there? We need to investigate that to ensure that everything is exactly as it should be. As you are dealing here with not so much a case of cost of sales, then that may not be unusual. There may well be economies of scale that are coming in. We also note from the information given to you that freelance web designers, freelance specialists have been used in the last 6 months. Okay, so read the information very carefully and just link that back. Okay, so freelance specialists have been coming in, yet the operating expenses have not really increased that much. So the due diligence is going to have to look at a detailed analysis in terms of those operating expenses and match those operating expenses to the revenue with the freelancers coming in. Freelancers are new, so therefore you would expect the operating expenses to be higher. As always, cash. Due diligence should be looking at the cash flows of the business. You haven't exactly got detailed information here, but it's always useful to know how much cash is being generated by the business, how that cash is being invested. Is the cash being stripped out by the venture capitalist? All right, that's more than enough information for you to pick up in terms of identifying and explaining the matter. Excuse me. In terms of identifying and explaining the matters you would focus on, but what additional information would you need? All right, just running through some of the ideas. You're going to need the contract and the legal documentation to look at the investment which BizGrow made. You may have mentioned this earlier, but it's now fitting into the second part of this. Are there any other shareholders of Missen? So we need to look at the company documentation. Employees and roles within the business. We've got 50 employees, but which of those employees are going to be the key employees? What involvement does BizGrow have in the day-to-day running of Missen? Who actually makes most of the decisions? We need to understand the consequences of redundancies. We need to understand the consequences of any golden goodbyes. So what could be the exact damage done, especially with Vic and Lou, in terms of if they were to leave the business? We need to look for the hidden details of the compensation. Who are the freelance web designers and exactly what work are they doing? What contracts do they have and how are they being paid? What are the key terms? What innovations have been created and the patents and copyrights of those innovations? Hopefully there will be patent and copyrights. As here you are dealing with significant intellectual property, who owns the property? Interesting case here of the development of, for example, computer games. And Pac-Man, there's a popular film recently released on that, but that did indicate the background to that. One gentleman was responsible for Pac-Man, and I think it was a Sony employee. Did he benefit? No, because his contract basically said that all of the intellectual property that he developed was owned by the company. So we need to look at those contracts. Now again, that is something that you may not think about, but you would think about it if you had worked through as many questions as possible. So look at the contracts and the terms and conditions of contracts. Look at what belongs to the business, because this is intellectual property. Who are the customers? How much do they utilize? How much do they pay? So we need contracts with the customers. And how much is going to be future in terms of the maintenance that is going to be provided. We talked about the rental agreement with BizGrow, so we need a copy of that. And the particular point there is what the penalty could be payable on the cancellation. We talked about the non-current assets, so we need to identify a register of non-current assets. We want to identify if any of those assets are actually held on leases. If there are leases involved with the assets, then we need copies of the lease agreements. So there could be some very powerful computer equipment and maybe photocopiers. Photocopiers would be the usual one that's on the lease form of agreement. What type of budgets are there for the future, the capital expenditure? So on that basis, if they are expanding, what additional computer power are they expecting to bring in? We talked about the revenue recognition, so we need to know what the accounting policy is on the revenue recognition. And in particular, given that we are moving from revenue recognition IAS 18 into IFRS 15, what's going to be the impact of the change on revenue recognition in terms of IFRS 15? How can they demonstrate that the criteria of 15 is being met? We talked about the operating expenses, so we need a detailed analysis of those operating expenses. That's more than enough to have hopefully given you good ideas on how you can gain those 16 marks. Let me check, have we any questions coming up? Right, one question. Let me just check if that's the only question. I've got quite a few questions coming in now. So, right, the first question, let's clear these now. First new question. How is business risk leads to audit risk? I mean, what is the relationship between business risk and audit risks? Don't get the two mixed up. Let me just go to the whiteboard here. If we look at audit risk, remember audit risk, look at the definitions. Audit risk is inherent risk, control risk, and detection risk. But what's the definition of audit risk? That's the risk that the auditor is going to give an inappropriate audit opinion, usually meaning that they did not modify their audit opinion when they should have modified their audit opinion. Okay, we talked about a business risk approach from ISA 315, and that's identifying the business risks that could lead to material misstatement risk. So we have a business risk that could lead to a material misstatement risk, and that can lead to an audit risk. The biggest business risk is going to be going concern. If we look at the ultimate business risk is going concern, that can lead directly to an audit risk problem in that the auditor does not identify that the company has a going concern situation, or if they do, then you're looking at disclosure, the disclosure notes on that for emphasis of matter. If the disclosure notes are inappropriate or the client is using a going concern basis when it is not appropriate, then the auditor is looking at modifying their audit opinion. So there are many business risks around which may not automatically result in an audit risk. So just make sure you understand the distinction between those two particular points. Understanding business risk is a tool to assess inherent risk and control risk. That feeds into the audit risk model. If you identify inherent risk and control risk, but fail in your detection risk, you fail to develop the necessary audit procedures to identify if there is a material misstatement, then you have audit risk. Second question, next question. If risk of material misstatement is high, because inherent risk and control risk is high, then it will cause audit risk to be high as well. Whoa, great one. Right, let's go back to very quickly here. This is F8 stuff. Seriously. But far too many students at P7 get this somewhat confused. Audit risk is fixed. Let's say it's 5%. I say it's fixed, but an acceptable audit risk is 5% in that the auditors are 5% certain, or there's a 5% risk that there could be a material misstatement. They are 95% confident that there are no material misstatements. Okay? If you want to be 0%, if you want to be 100% certain, then you've got to test absolutely everything. That's impractical. So 5% tends to be an acceptable theoretical norm. Okay. But with inherent risk, if we go with that 5%, then you could argue that the highest inherent risk is 100%. The highest control risk is 100%. So in theory, the detection risk must be 5%, or high, high, low. This is theory. Okay, so you're coming at it from the wrong perspective. What you will have to do in this situation, that virtually what you are saying is that you're 100% certain that there could be a material misstatement, the controls are not operating, or you do not decide to rely on controls, therefore the control is not going to prevent, detect and correct material misstatement. So to have an audit risk, you need a 5% detection risk, which means there's a 5% chance that your audit procedures will not detect a material misstatement. But always remember that in terms of your detection risk, you will always test 100% of material items. So in that case, you could argue that if you're testing 100% of material items, then for that 100%, you should be certain that there will be no material errors. But that's going to depend on whether you actually do identify all of the potential risks that could lead to a material misstatement. And you're looking at the differences between quantitative and qualitative material misstatements. You're looking at the use of professional skepticism, professional judgment. So there are many, many different ways in which the auditor could actually end up with an unacceptable audit risk. So the auditor has to reduce the detection risk to an acceptable level. If they cannot reduce the audit risk to an acceptable level, then they may decide that they don't really want to be involved with the audit, or they're going to be looking at modifying the audit opinion. So for example, if they cannot get sufficient appropriate audit evidence, which is what detection risk is about, if they cannot get that sufficient appropriate audit evidence for perhaps that the audit evidence is not available, then they will be looking at modifying their audit opinion. I hope that gives you a clue in terms of what you said there. Next question, business risk broader than audit risk, yes? Audit risk related to financial statements, whereas business risk related to business concern about business strategy. Yeah, I would agree, but remember that the ultimate business risk is going concern, and that's going to feed straight into your audit risk. Right, due diligence. In due diligence, do we have to look for higher risk areas of business and audit? Ignore the audit. Okay, this is business risk. This is looking at it from the client's perspective. So what within the business, what events within the business could stop the client achieving its strategy, its objectives. So when you say high risk areas of business, yes. So you might have a strategic risk, you might have operational risk. This is going back to all the risk variances from P1, all right? When you've identified those risks, and this is another type of question that comes up, you could be asked to identify the business risk, and then you could be asked about how that business risk could lead to financial statement risk, the risk of material misstatement. For example, we looked at the happy monkey and the children, the potential problems with the children. We looked at the happy monkey with the potential problems of health and safety. Okay, now if a child falls off and injures themselves, or if the restaurant customers become poisoned, then that's a business risk, because that could lead to a reduction of the customers. It could ultimately lead to a going concern issue. But the customers and the families of the children are likely to sue the happy monkeys. So then that leads to a risk of material misstatement, in that the potential liability may not be disclosed. So here, okay, you need to understand the liability, potential liabilities, and liabilities that you can totally ignore. So if it should be disclosed, it must be disclosed. So the financial statement risk is the fact that these items are not being disclosed. Can we recalculate the depreciation in review engagement? When you're talking about a review engagement, then bear in mind, if you're going beyond the concept of due diligence, with a review engagement, you are using analytical review and you are using inquiry. So depreciation is a standard analytical review procedure. So you would calculate, yes, I would calculate the depreciation on that. Okay, but I would not go and inspect the assets. That is not review, that is audit. So inspection of the asset is audit. Identifying impairment is audit. You can make inquiries of the management. Do the assets exist? Yes. Are any of the assets impaired? No. But for depreciation, then yes, because it's part of the analytical review, standard analytical review procedures. Can we review substantive procedures in a review engagement? Be careful, because substantive procedures, you're tending to think about, for example, do the assets exist? Are they complete? You're going back to the assertions. You're going back to assurance. You're going back to audit. That's not going to be what a review is about. A review is going to be about carrying out analytical review and asking questions of management inquiry and analytical review. So as close as you get to that, you might carry out an analysis if you're doing a review, and if you've got the monthly management accounts, then you may well do an analytical review based on the monthly management accounts. If you've got a 5-year summary, then you could do an analytical review based over the 5-year summary to see if everything appears to be acceptable. But that's as close as I would get in terms of substantive procedures. How important is it to mention the ISA in exam? Do we have a mark? No, you will not have a mark. I use the rule that if you cannot remember exactly the ISA, then don't mention it. Just say, in accordance with international standards on auditing, the auditor is expected to do blah, 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 blah. Okay, but there are some standards that you should automatically remember. For example, ISA 315, 330, 560 going concern, ISA 700, the auditor's report, 705, 706. However, in the panic of the exam, try not to go down that if you don't know. The chances are, if you did and you mentioned the wrong, there's no marks to be lost. Okay, the market knows you're under pressure, and therefore if you mention the wrong standard, but you give the right detail, you'll get the marks. And at the end of the day, if you wanted to know the standard, in practice, you just look it up. You go to your IFAC website and look up the standard. Okay. Notice on this question, if there are no more questions, good. Any more questions, please put them up. But let's just go back and look at this last element of the question. In that, right, describe the type of conclusion for a due diligence report, and compare this to an audit report. Wonderful part of a question at long last. After many, many years of always asking questions about an audit report, at long last, we have a form of assurance report. It could come up in December, it could come up in your exam. So basically, the main difference between the two is going to be the level of assurance that can be given. A review report is a negative form of report. Okay, that's going to be a lower level of assurance. High levels of assurance, then you may be able to give a positive form of the report. So before accepting the engagement, and that's often another question that comes up in terms of what do you need to know before you can accept the engagement? Well, apart from are you independent, apart from do you have the capabilities, do you have the time, then what exactly does the client want? Are they looking for a form of assurance report, or are they looking for a statement? Are they looking for a higher level of assurance, or are they looking for a lower level of assurance? What type of report are they expecting to give? Okay, so at long last, something came up. And interestingly, there was another question. I cannot remember the name of it, unfortunately, but it was connected with a review report. And a lot of students did not understand that you could actually modify a review report. If a standard review report is saying nothing came to our attention to make us believe X, Y, Z, what if something did come to your attention? What would you do then? Would you just ignore it? No. The logic is that you would need to report that in a modified form of report. So just make sure you know the type of standard of reports that you can give on this. Okay, I make it that we have something like 30 minutes left, and questions have been coming up about dealing with what IFRSs we need to know, etc. So let's just have a quick look at this type of question. If I can find exactly what it is, evaluation review, audit of financial statements. Let me just have a quick look at that. Yes, there's a standard approach to this type of thing, certainly that we at Becker indicate for you to do, is when you look at these questions, these type of questions, review style questions, audit of financial statement type questions, and I will move on to an example of a question in a few minutes time. But when you look at these questions, the first thing you want to look at, is it material? But in quite a few of these style questions where you're dealing with IFRS, assets, liabilities, potential situations, is it material? Because if it's not material, why worry about it? But don't forget, of course, that you have to think about quantitative and qualitative materiality. There we have. And don't forget about the disclosures. Look at the history. And as part of the answer, always calculate the materiality. Don't just say it's material. Calculate it. Okay, mention the accounting standards. Now you can see here on assets that we have 16, 17, 20, 23, 36 and 37 IFRS 5. So always try and mention the standards that are involved. Again, if you cannot remember the standard, just say that the reporting standard, the accounting standard on fixed assets, non-current assets states this. Okay, as long as you get the background correct, you will get the necessary marks. What assertions are going to be most at risk? So, okay, mention the assertion. If there's an impairment, then you're looking at valuation. If you're looking at revenue, then the completeness of revenue could be a problem. There may be cut-off as a problem, but always state what assertion it is that you are looking for and you are looking at. Then, what evidence would you expect to be available? Very easy marks. We've already touched upon this in terms of one of your questions that came up. Look for clues within the scenario. If the scenario talks about a report, you want a copy of the report. Okay, it's that sort of extra mark, and that can make a lot of difference between passing and failing. It only takes 1 mark, remember that. Okay, standard, internal, external, written or oral, direct or indirect. And then finish up what's going to be the impact on the audit report. All right, just looking, as I've given you assets, in most enterprises, yes, it's going to be material. Calculate it, calculate the impairment, damage, and that's one other clue to always think that when you have an asset in a question, think impairment. 9 times out of 10, it will always be there. Then, what assertions are most at risk? So you need to understand the assertions relating to that particular asset or liability or revenue or expense or disclosure. What evidence would you expect? Well, there'd be a non-current asset register, invoices, authorization, maybe reviewing board minutes for the authorization. Should definitely be authorization if the asset has been disposed of. If there are valuations, what about the valuation report? Think about the client's experts, management's experts. What about forecast, budget forecast? Does it fit in terms of planned asset expenditure? Held for sale assets, IFRS 5, have they been appropriately accounted for? And any fair value of assets, well, chances are you're dealing there with the expert opinion on those assets. Okay, I'll leave this up here similarly for goodwill. Okay, you'll come back and have a look at that when you get your copy of the presentation. Just gives you some idea of the type of things that you need to work through. But you do need these lists to remind yourselves about how far you need to go back. I think somebody asked a question about how far do we need to go back in terms of IFRS. Well, here's the answer. Okay, you do need to understand the basics of what the IFRS is about, and in particular the disclosure requirements, and in particular the recognition criteria and the measurement criteria. Okay, we have just about 20 minutes to go unless we have any more questions. So let's have one quick look at another question, which was December 13. Here's December 13, and we've gone through one question. The next question on December 13 was question 3. That's question 4, gone a bit too far. Right, this is question 3, December 13. Very typical type of question that comes up. Question 1, you need to state the main audit procedures that you would carry out on a particular asset or liability, for example. Here, this is the review end of the spectrum, and it's just saying here, in respect of the accidents at the mine, comment on the matters you should consider and describe the audit evidence you would expect to find in undertaking your review of the audit working papers. So comment on the matters, the audit evidence you want to find. All right, let's just pick up on what the matters are. And because we're looking at the time factor here, we'll just have a quick look at at least one of them. Right, okay. If you'd like to read that through, please. Okay, I'm just going to slide this up. Ah, the requirements are there, so okay, carry on. All right. Hope you have read that. So, what matters should you consider? Normally, in this style of question, the matters are given to you in separate paragraphs, but in this particular one, we just got an accident and the detail of the accident. So the examiner is asking you to think about what the potential matters could well be. And we have 14 marks. The total marks will be split equally between each part in terms of A1, A2. So we've got 7 marks for commenting on the matters and 7 marks for describing the evidence you would expect to find. What do we know about the matters? Right, operates in the coal mining industry. So straight away, if it's operating in the coal mining industry, then you should be thinking of laws and regs. And you'll be thinking of health and safety straight away. 10 mines across the country, being sold on to customers who are energy providers. Coal mining companies operate under license from the National Coal Mining Authority. Okay, so that's great. So here we go. The audit evidence you would expect to find, you would expect to find the license. So let me just tag that up. So on the permanent audit file, there should be copies of the license. It's an organisation which monitors the environmental impact of coal mining and requires coal mines to be operated in compliance with strict and health and safety regulations. Okay, so you would expect to see copies of what the health and safety regulations would be, and you would expect to see any investigations. Not investigations, inspections. So when was the last inspection carried out? And what's a copy of that inspection? Right, standard procedures, you're the audit manager, draft financial profit before tax of 18 million and total assets of 175. Why has the examiner given you those figures? Well, she's giving you those figures for the simple reason to calculate materiality. Right, there was an accident. Several of the tunnels in the mine collapsed, causing other tunnels to become flooded. All right, so straight away, matter to consider is impairment. So you're going to have to, one of those matters that you're going to have to discuss is going to be about impairment of the assets. Well, okay, if it's impairment of the assets, what do we know? 1/3 of the mine becoming inaccessible for safety reasons, permanently closed, thinks that the rest of the mine can remain operational as long as improvements are made to ensure that the mine meets health and safety regulations. So the improvements are going to be made later. Okay, we're not going to get too concerned about that. But I mentioned materiality. All right, so later on in the draft financial, the Lodge Hill mine was at 10 million. So is it material? Yes, it's 10 million in terms of total assets of 1.175 million. which is about 5.7% of the total assets. And total assets are in the region of about 0.5 to 1 to 2%. So it is material. What standards are involved? Well, if you cannot remember the particular standard, is it 36, 37, 38 in terms of impairment, then don't worry about trying to guess which ones you might just slightly guess it wrong. Just say that the asset has been impaired and therefore there needs to be an impairment review. Let's add the word review there. So what information do we need? We need to be able to look at an impairment review. If it's not being carried out, then the risk is that the assets are overstated and the profit is overstated. 1/3 of the mines become unusable, so potentially we got a lack of total future economic benefits on that 1/3. So 1/3 needs to be written off. 1/3 of the 10 million is 3.33 million. That is 18.5% of the total profit for the year. That is material. So go through utilizing that 10 million in connection with the 175 and the 18 million. Okay, however, this is P7. It's doubtful. We've got doubts at the moment. It may be that the whole mine may not be usable. So there may need to be disclosures on exactly what has happened. So IAS 1 presentation of the financial statements requires that anything that is material must be disclosed. So the detail of the accident and the potential damage, the best case scenario and the worst case scenario would have to be disclosed. No one was injured in the accident. Let me just clear this up so we can see what I'm talking about. However, the collapse caused subsidence which has damaged several residential properties. Aha! So in that case, what is going to happen? There will be claims. We're going to need provisions. So what is the company doing about provisions? IAS 37 provisions, if you can remember that. IAS 36 relates to the impairment. Right. So chances are there should be a need to recognize a provision. How is that being calculated? So some of the information you will need to see on file, part B, would be the company's estimates of the provision. So that's going to be looking at the claims that have been made. It may well be a surveyor will have carried out the claim. So the coal company may well have their own surveyor to go and estimate the damage. So you want to see their work. The criteria for provisions certainly seems to have been met. The accident was before the year end, and this is going to relate in future economic outflow. What about the fact that a group of 20 residents have been relocated to rental properties? So how long do they expect? We've got the surveyor here who's done the commissioning. How long do they expect those residents to be relocated? That will need to be provided for. Some of that expense will be charged against the current year. The rest of it will need to be as a provision. So in terms of the surveyor, we will also then need to know how long it's going to be about repairing, or how long will it be to demolish and rebuild. I'm going to add an extra one here called plus, 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 plus. This is looking at P7 skill. What other cash flows could there be in the future? quite often that where an accident is involved, then some of the residents, for example, may well be self-employed and they work from their home. So there could be loss of profits for the residents' business that could well come in. There could be stress-related claims that are coming in. It's saying here that it talks about no employees were injured, but could there have been some stress-related injuries to the residents? There could be stress-related injuries to the employees. All of those matters would have to be considered, and therefore they would need to be recognised. If they're not recognised, then the profits are overstated and the liabilities are understated. If these cannot be reliably measured, then you'll be looking at contingent liabilities. Finally, as every student likes to throw these sort of things in, there could be going concern issues. However, Hedge Hill Mine is relatively small, so on its own, that may not cause any particular problems. But the management have decided not to report the accident to the Coal Mining Authority, and bear in mind that they operate under license, then that could result in the license being completely withdrawn from the company, in which case Desert & Co. is not going to be a going concern. Right, we've got 5-10 minutes left. The evidence, I've already indicated some of the evidence that would need to be there, but other evidence could be the board minutes where the accident was discussed, for example, the quotes that have been obtained for the repairing of the work. We've got the report of the surveyor. That will definitely need to be there. Any correspondence with the local residents, the claims from the residents, the indications of stress-related consequences, any legal correspondence between the mine solicitors and the claimants would need to be there. Any press reports would also need to be there about the mine, what's been happening, okay, and details of the impairment calculation, the impairment losses. And because of the consequences of this, then of course the famous representations would need to be obtained from management that all of the information that they have made available to you, or they are not aware of any further consequences other than everything that have been declared to the auditors through the letter of representation. Okay, another thought-provoking. Any more questions? Okay, there's one question about how do we set the materiality level. There's only ever been one question where a materiality level has been asked to be calculated, but relate back to the materiality levels that, for example, that by looking at materiality, the calculation is 5 to 10% of net profit, 0.5 to 1% of turnover, 1 to 2% of net assets, and 0.5 to 1% of gross assets. When you've got those calculations, you then need to determine the limits, and you then need to use the partner's judgment as to where you would set the materiality level. But that's the planning materiality level. You then have the performance materiality level, which is going to be the risk that the accumulative immaterial or undetected errors are greater than the materiality level, the planning materiality level. Setting the performance materiality level is purely professional judgment. As a rough guideline, that may well be 50% of the planning materiality. Okay, is management representation a sufficient audit evidence? 95% of the cases, the answer is no, it will not be. You need to get sufficient appropriate audit evidence, and in the vast majority of cases, the audit evidence should be made available to you. Where the management representation comes into play will be on the credit items, the negative items, where it could be easy for management to withdraw information. For example, that could be on related parties. They may not disclose all of the related parties to you. Okay, I think we now have something like 2 minutes left.
And you have a table there?
Are there any further questions coming up? Because let's go back to my PowerPoint, and I just want to run through what's going to happen. Ah, I've lost it. Okay, sorry about that. I think we'll just go through to the end slide here, because what's going to happen next is that you are going to have your mock exam. Okay, so make sure you know the date of your mock exam. Make sure you actually sit your mock exam. In fact, my apologies, the next thing that is going to happen is going to be that you need, as a homework, you're going to sit the June 15 exam. Sit it under exam conditions. Then you'll sit the mock exam, and I will review that mock exam for you on a set date, and I've forgotten the date of that at the moment, so my apologies for that. Okay, and then I will also do a quick review of the June 15 exam as part of that that exercise, those 4 hours. With the mock exam review, I'm going to be concentrating a lot more on exam technique, but for the last point of the exam technique, I'm going to reiterate again and again and again, you need to know your examiner. And let me just come out of this. This will be the last point for a minute. You need to know the examiner. How do you need to know the examiner? Well, that's easy. Go through the study system. Then, examiner's articles. Trying to rush and not getting this done very well. Examiner's articles. Then, the examiner's reports. Then, past exams. Past exams, I would say, is particularly important on the basis that you've done the study system. But keep up to date with the articles, because if any articles appear between now and the exam, then the chances are it's going to form the basis of a question in the exam. Okay, we'll deal with this in much more detail later, but this is what you need to have done before you sit the real exam in December. Most certainly, past question, past question, past questions. I think that's covered everything. I've just remembered now, there was an earlier question about forensic auditing. My apologies. I'll try and remember to pick that up when we look at the review in the next session. But forensic auditing is basically using auditing skills to determine any legal or fraud consequences. So if a fraud has been carried out, then forensic auditing is to try and identify the cause of the fraud, what controls should have been in place, and to quantify the fraud, and, for example, to attempt to identify who the fraudster would be. If we're dealing with insurance claims on loss of profits or loss of inventory in a fire, then you're using auditing skills to determine that the claim is not materially misstated and that a fraud is not being carried out. Okay, that is it from me. Thank you very much indeed for attending this and participating in this. I sincerely hope that what we have covered will have given you a lot of ideas. Most certainly at this level, 50% of passing the exam could well be technical, but the other 50% is going to be the communication, the application, and the understanding the higher level skills that I've tried to emphasize, that I've emphasized in looking at these particular questions. Hopefully by now you appreciate that you may have technical skills, but you've got to be able to utilize the practical aspects of those skills in order to pass the exam. And the only way you're going to do that is to practice, practice, practice past exam questions. Okay, that's it. Thank you very much. I'll now hand back to the moderator.
Thank you very much, Keith. That was indeed a wonderful session. Those who are listening, we will be signing out shortly. The system will automatically ask you to leave a feedback.